Hi, this is Jim Cunningham. We're going to talk about the top 5 strategies, and I had to winnow it down. There are more than 5, but the top 5 strategies to avoid death taxes. Now, when I say death taxes, I am not talking the political term because that term has been politicized. I am talking about death taxes because there are taxes that happen when somebody dies. There are federal death taxes and state death taxes in some states. So we use those together to talk about both the federal and the state death tax. In 2023, the federal estate tax rate is 40% on amounts over $12.92 million. Now, this is a huge number. When I started practicing law, it was 600,000. Anything over 600,000 could be taxed as high as 55%. So we're in a fairly low, believe it or not, a low tax environment when it comes to people passing away. However, January 1, 2026, that $12.92 million exemption, that's getting cut in half. So it's adjusted for inflation. It'll probably be about 7 million. That's kind of where we're guessing. You know, all the smart kids are kind of guessing it'll be 7 million. So that means anything above 7 million is a 45% death tax. So folks, the clock is ticking. If you have an estate greater than $5 million or know someone who does, you really do need to pay attention to this, because that's really kind of the it depends on your age, but that's kind of at 5 million, you really should be paying attention to this. I'm Jim Cunningham. I'm a partner at Cunningham Legal. I've got over 25 years experience. We have offices throughout California. I am a certified specialist in estate planning, trust, and probate law, a real estate broker, securities insurance licensed, and a third-generation pilot. These are the lawyers in our firm. We are dedicated to helping families get peace of mind through multi-generational estate planning, as well as planning for wealth and protection and all those things. So if you're watching this on YouTube, go ahead and subscribe to our YouTube channel. We're doing a live webinar, and we do these typically Thursdays at noon Pacific time, and then we post them typically later that day, Thursday. And so these are on our YouTube page. If you have never seen our YouTube page, I really recommend you check it out and go ahead and click and subscribe. Disclaimer, I'm a lawyer. I'm talking. Words are coming out of my mouth, right? This is absolutely not legal advice. You watching this does not create an attorney-client relationship. The bottom line is, don't watch this and go out and do a bunch of stuff because I talked about it. So with that in mind, death taxes, it has been said, are optional. And what you're going to see is it really doesn't matter how much you have. This is true to a large extent. Given enough time, given the proper planning, given all these things, you're going to be blown away when by the time we get through the material, you're going to be like, wow, death taxes really are optional. You can't avoid death. At least no one's done it, right? We're human. We're born and we die. We leave this earth. You can avoid death taxes. These are optional, but it does take time. It does take good hygiene. Now, I'm not talking about washing your hands before you eat, but you have to pay attention to stuff, good habits. And I would say a very important critical part of this is an A-team. Now, I am not talking about the A-team from the 80s or the more recent A-team, but if you're listening to this and not seeing the video, we have a picture of the 80s A-team on there. And the idea here is you need the attorney, a CPA, and financial advisor. Those are kind of the 3 principal advisors that work together. They need to work very closely together because there are gaps in knowledge and gaps in training, and we all kind of stand together. It's like a 3-legged stool. We all need to be working for the client. So I would say that there are 6 different types of taxes that have really different rules. And there are trade-offs. And so it's, well, if you do this, it's going to cause a problem over there. It's a bit of a whack-a-mole. The first one is income tax. Now, that's the one we pay, every year. We're subject to it on an annual basis. That income tax, you make money, maybe realize a capital gain, that gets you into capital gains tax. But the idea is you're paying this annually. Property taxes, and in California, where I am, we have something called Prop 13, which protects taxpayers. It protects owners of real property from increases in their property tax, and also taxes property at a reasonably low rate, lower than it used to be. And that is also, a lot of people are concerned about preserving Prop 13 capital gains. So when you sell something, if you buy something for $1 and sell it for $3, you're subject to tax on that gain of $2. Then there's the death tax. In California, we have the federal estate tax. That's it. There is no separate state death tax. There's no separate state inheritance tax. So if you were to inherit money as a California resident, there's no separate tax just because you've inherited. It's not true with all states. And so, some people characterize the reassessment of property, when a parent passes away and that property passes to a child and those property taxes go up, that is characterized as a death tax. I can see the argument that you're making for that because you don't really choose when you die. You just die and then your property taxes go up. So it is a form of a death tax. So we don't have a death tax in the sense of if you inherit something, you have to pay taxes, your annual property taxes might go up. There is also a gift tax, which we don't really see much in practice. You'll see why. There's also a generation skipping transfer tax, meaning if you leave stuff to the grandkids, that is skipping a generation, and it's subject to an additional tax. And we'll cover these broadly speaking. So I think understanding our current federal estate tax or death tax rules is the beginning. So understanding our current federal estate or death tax, really, you need to understand the system before we can really talk about the taxes. There's some foundational knowledge. So the real question here is we're focused on federal estate tax right now. What can the United States government tax? Now, there was some talk in the not too distant past of, hey, maybe the US government should have a wealth tax. Well, the reality is if you talk to legal scholars, the US government does not have the ability to do that. It just doesn't. The US Constitution would have to be amended. So the US government can only tax transfers. What this means is if I sell a piece of property to somebody else, that's a transfer of the property. I'm getting money in return. When there's an exchange like that, I give a person a piece of property, they give me money. The US government can tax that. That's the 17th Amendment. That was, started income taxes. So the US government can tax that based on the US Constitution. The US government cannot tax assets. Now, when it comes to estate planning and when it comes to death tax planning, something very important to understand is the US government taxes what is actually transferred. Now, what do I mean by that? Well, if mom gives a third of the property to each kid, a third, what mom is given is not necessarily the property. She has given a third here, a third here, a third there. So she's given thirds away. Each third is valued, and we're going to revisit that in a little bit. And that's another tax planning strategy that people use. It's called discounted valuation. So we'll talk about that. Well, let's talk about the federal death tax. It's very, very important to understand. I would say that the vast majority of estate planning attorneys don't understand this enough. And I'm just going to call it, right? Because I talk to other lawyers and it's kind of murky, but I'm going to give it to you in simple terms. In 2011, we got under the Obama administration. By the way, when I mention presidents, I am saying when this happened. Okay. This is a historical reference. It's not a political reference. Under the Obama administration, we got a $5 million exemption in 2011. That law stated that the $5 million exemption, so you can leave $5 million tax-free, right? That $5 million tax exemption is indexed to inflation. So that is now 6.46 million, which was 5 million in 2011. In 2017, under the Tax Act that happened late in 2017, under the Trump administration, that doubled. So we got an extra 5 million adjusted for inflation. So they kind of use that 2011 number. Here's the kicker. That amount, that 6.46 million that we got in 2011 and 2017, the Trump exemption, that Trump 6.46 million goes away January 1, 2026. It's gone. And here's the other wrinkle on this. If you make a gift, there's an ordering. So the first is you make it from your DSUE. Now, what is that? We're going to talk about that. That is the deceased spouse's unused exemption. Portability, we'll talk about. If you have a spouse, you get to double up on this. If you have had a spouse die within the last 5 years and haven't filed your federal estate tax return form 706, you may be leaving a lot of money on the table. We'll talk about that. So first, it's from your inherited exemption you got from a spouse. Then it's from the Obama cake, then the Trump frosting, because in 2017, that Trump frosting is going to be wiped away. So if you want to make a gift and take advantage of this expanded death tax exemption, you may have to gift, and I'll put that in air quotes, you may have to gift a lot to really get a benefit. So a couple that maybe has a $20 million estate, one spouse may have to gift 13 million to get a benefit. So, so stated another way, in order to make a gift of this Trump exemption that's going away in 2017, you have to first give away your Obama exemption. Then you go into the Trump exemption. If you only give $3 million, That's it. Your Trump exemption's gone. Now you have, $3.46 million left when you pass away. So I hope you got that. If you didn't, maybe you can hit rewind and listen to it again. This taxes are also going up. So the federal estate tax exemption is due to be cut in half in 2026, January 1, 2026. It will be around $7 million a person, and it's 45% on amounts over that. So not only is the amount you can leave going down, but what you do give that's taxable, the tax on that is going up. So this is really critical. So if this is you, maybe your parents, maybe your loved ones, maybe a sibling, if a spouse passes away, the surviving spouse has the ability to file what is called a portability federal estate tax return. So what this means is the spouse who dies is the deceased spouse. The surviving spouse is the surviving spouse, right? The alive spouse. So the dead spouse is the deceased spouse. The alive spouse is the surviving spouse. The surviving spouse gets a step up in tax basis. Number one, what do I mean by this? Well, if you hold community property, you're a California resident, one spouse dies. Let's say you bought a whole bunch of real estate for $1 million. Now it's worth 10 million. The surviving spouse, when that deceased spouse dies, the surviving spouse can sell that $10 million in property tax-free. So that capital gain is wiped away. Very, very important. It's very important that you get your properties valued. You seek, counsel with an attorney. If this is you, if you just had a spouse pass away and you don't have a lawyer, please reach out and give us a call. We can certainly help you. The surviving spouse gets this step up in basis, and the surviving spouse can also claim the deceased spouse's unused federal estate tax exemption. The acronym is DSUE, by timely filing a Form 706. Now, normally, this is due 9 months after death. And if you're married, you can get a 6-month extension. But there's a 5-year window that recently the government's come out and said, look, if you had a spouse die 4 years ago, it's not too late. So very important. We're going to cover that. So Abel and Baker are married and own 10 million in Apple stock with a cost basis of $1 million. Baker dies. The B spouse is the buried spouse, right? Baker dies. Abel can sell the Apple stock for $10 million with no capital gains, or hold on to it, right? But let's say Abel keeps the Apple stock and timely files a Form 706, right? This is the portability return. Abel claims Baker's, the buried spouse, deceased spouse unused exemption of 12.92 million. So what happens is Abel in 2023 has an exemption, this ability to leave property tax-free of 12.92 million, plus Baker's 12.92 million. That's 25.48 million. That's a lot of money. And you might think, and I will tell you, so I talked to some advisors and they say, you know what? What are you worried about? Why are you filing that thing? You got 12 million, you have a $10 million estate, you can leave 12 million tax-free. Well, guess what? That 12 million or 13 million that you leave tax-free, that's getting cut down to 7 million in 2026. So if you have a $10 million estate and a spouse dies, you really need to pay attention to this, because in this case, Abel picks up Baker's $12.92 million exemption. And then in 2026, Apple doubles. I hope it does. I'm an Apple shareholder. Unfortunately, Abel can leave 7 million tax-free. Okay. So what's happening here is Abel inherits $10 million has $10 million in tax when Baker dies. And that 10 million then goes to 20 million. Well, Abel only has a $7 million exemption. So that means 13 million is subject to tax at 45%. But because Abel filed this federal estate tax return, Abel picks up Baker's $12.92 million exemption. So no federal estate taxes and a second adjusted cost basis. So when Abel and Baker's heirs inherit the Apple stock, no capital gains tax, no death tax in this example. So this is why it's very important to consider filing for portability if you lose a spouse. So Charlie gets this other adjusted cost basis and can sell the stock for 20 million, no taxes at all, right? So even if a spouse dies, or when a spouse dies, consider timely filing a portability 706, even if you don't have a taxable estate, because your assets can go up and the law can change. And as you know, laws change. So the big takeaway from this is if you're married and you've got, you really consider this portability 706. So how do you timely file? Well, it used to be 9 months plus maybe an extension of 6 months. But in July of 2022, the IRS came out and with Revenue Procedure 2022-32 and provided an extension. However, the extension There's some qualifications, meaning you have to be survived by a surviving spouse. If you're a registered domestic partner in California, that is not a surviving spouse federally. So if you are an RDP, registered domestic partner in California, that is interchangeable with spouse. This is something you may want to consider or not, but you need legal advice on that. So survived by a surviving spouse, was a U.S. citizen or resident on the date of death. No federal estate tax return was required to be filed because the estate wasn't a taxable estate. And then no estate tax return had been filed. So little bit of detail on here, but you do have 5 years. So if it's a situation where one spouse passes away and the surviving spouse now has $5 million, right? Because that was the estate, and that deceased spouse died 4 years ago. The surviving spouse, this is kind of the easiest. This is why I'm leading with this. This is the easiest way to cut death taxes. File for portability, pick up that extra exemption. It's kind of a freebie, right? So we've got some detail here. I'm going to kind of skip through this. So key concepts in planning in my world: portability. If you're a surviving spouse, that's really the first order of business. Should you be filing your 706? Basis management. When you gift a property, if I give something I paid $1 for that's worth $10 to my son, he gets my $1 basis. Okay. Meaning if he turns around and sells it, then you're subject to a capital gain. I will say one pattern I see is wealthy families oftentimes have very low basis assets. There are strategies based on a shorter life expectancy versus a longer one, premature death versus longevity. So we would use one strategy if somebody says, I just don't think I'm going to make it past 70 and I have a lot of assets. We might use one type of strategy. If the other one says, hey, I'm making it to 110, we're going to use potentially another strategy. So these are strategies based on longevity. We also look at a gift versus a sale. So a gift is where I give something with nothing in return. A sale is typically has a promise to repay, interest, and security. So that's a little bit different. And when I say sale, just set aside capital gains tax, because there's a way to completely avoid capital gains tax in estate planning. Ownership versus control. These are concepts. Ownership versus control. You can own it, meaning you control it and you get the economic benefit. Control means you don't necessarily get the economic benefit, but you're still in charge. And so a lot of these planning strategies are foregoing potentially some economic benefit and still being in charge. And in some strategies, you can't be in charge and you have to give up the economic benefit. But again, it's what's appropriately tailored for the client. Debt versus equity, very important. So this is a little bit like gift versus sale, debt versus equity. This is where the space of notes, assets versus notes, and income tax burn. What we're going to talk about that is if the family, and one thing to do is thinking about multi-generational planning with multiple taxpayers. So think about grandma and grandpa, kids, grandkids. That might be one economic unit in a wealthy family. In a multi-generational wealth creation structure, that's one unit. Well, the person who should be paying the tax is typically the oldest, richest person, right? Or the oldest person. Because what you want to do is if the family is going to pay tax at the highest rates anyway, you would want to pay those taxes from the person who is the soonest in time to be subject to death taxes. So I know it's a little abstract to talk about this. As we go through these examples, I think you'll have some clarity. So 5 big ways to defeat death taxes. Number 1, intra-family loans, lending money. We'll talk about, we have a couple examples: gifting, irrevocable grantor trust. Some people have heard the term of IDGIT, intentionally defective grantor trust. We'll talk about that. Dynasty trust, which oftentimes is a type of grantor trust, as well as a spousal lifetime access trust. So these are the 5 big tools that we're seeing in estate planning in 2023. So intra-family loans, what am I talking about? Well, when you loan money, for it to be a loan instead of a gift, remember I was talking about gift versus loan, a loan has to repay principal, bear interest at some rate, and have security. So some type of way to collect in the event of default. The United States government publishes something called the applicable federal rates. Now you can Google applicable federal rate, and there's sheets that come out once a month. This tells us as taxpayers what is the minimum amount of interest that must be charged when lending money. Now, this is like when lending money to a family member in our context. So for September 2023, it's about 4.11% for midterm and long-term loans. These are loans that are longer than a couple of years, right? Up to 30 years. So this presents on a very high level an arbitrage opportunity. So if you know that something is going to deliver an 8.11% return, right? You can loan money to somebody who then buys that thing that has an 8.11% return, right? And then they take the spread of 4% and you get your 4. So short-term loans are 3 years or less. Midterm loans are more than 3, but not longer than 9. And long-term are 9 years to 30. So 30 is the maximum term for a loan. These are, and different rates for different terms. So mom lends $1 million to Sonny, who puts $1 million in a CD with a yield of 5.4%. Mom gets $41,100 in interest that Sonny pays mom, and Sonny gets $54,000 in income, right? So, and then Sonny pays the mom $41,000. This leaves Sonny $12,900 at the end of 1 year. This transfer of $12,900 is not a gift to Sonny because he's borrowed the money from mom. This is an example of arbitrage, and he gets a higher rate. I'm not sure anyone would do this. I'm teaching you a concept, okay? Dad has $1 million and dad lends, daughter has $1 million mortgage. It's actually a more common situation. Daughter has $1 million mortgage at 8.11%. That's kind of where rates are. Dad lends $1 million to daughter who pays off her mortgage and drops her interest rate to 4.11%, saving the daughter $40,000 a year in interest expense. So dad's still, this is just a loan, a straight loan. And so you can see this is how you create wealth because the daughter is having $40,000 less going to the bank, which means that is $40,000 effectively accretes to her, accretes to the family on this creation of multi-generational wealth. A self-canceling installment note. Now, this is kind of a supercharged note. This is a note that extinguishes at death. Now, please pay attention to this. This is a really what Robert Keebler calls a bet to die strategy, okay? Saying that, you know, dad is healthy, but he's 60, he's healthy. He doesn't think he's going to live to be an old man. So what he does is he gives $12.92 million of the company stock to daughter, free of gift tax, and sells the remaining $10 million. Right, so he's got a $33 million company, gives $12.92 million, sells $10 million in exchange for a note. The note carries this is very important, a mortality risk premium, meaning the self-canceling installment note. When dad dies, that note dies with him. It goes away. It ceases to exist. So that you have to add a mortality risk. And in this case, I ran some numbers and currently for the month that we're in, September of 2023, that note would have to be for about $10.9 million. Now, what I'm explaining here is dad is selling something worth $10 million, but under the terms of the note, when dad dies, that note goes away. So whoever the borrower is pays a premium for the privilege of having that note become extinguished when dad dies. So this note goes away. You do have to basically juice up the value of the loan, and we use the applicable federal rates and some actuarial data to get that number. We put it into a computer, right? A calculator. And so daughter makes 2 payments. Maybe these are annual payments of $545,000. Then dad dies. That note is gone. Poof, gone. Daughter now got $30 million in assets, no death tax. So this is an example of how death tax is optional. Death taxes are not, given enough time and given figuring out if people are going to live or die. I know it's very grim, but it's the reality. We're talking about a death tax. So even though we have a $12.92 million exemption, it still may make sense to lend money, even if you have that exemption. If someone's not going to live a long time, self-canceling installment note can make sense. Some people don't want to give up their cash and others don't want to spoil their loved ones. And so repayment of a loan keeps them working for it, even if they're paying low or below market rate. So the example of the daughter who got the loan to reduce her mortgage. Gifting strategies. So now we're going to turn to gifting. And so when is a gift taxable? Well, if you make a gift directly to an educational institution or medical provider in any amount, these are not gifts. So if you're paying someone's hospital bill or paying their college tuition, that is not a gift. If you're reimbursing them for tuition, that is a gift. So you really have to be careful and pay attention to that. You can give a gift to a U.S. citizen spouse of any amount. If your spouse is not a citizen, it's capped at 175,000. Basically, the government doesn't want you to be married to somebody that is not not a citizen of the United States, and you give all your assets to your spouse, and then your spouse goes back to their, the country they're a citizen of and never pays federal death tax. So that's what's going on there. And for 2023, it's 17,000 per person, meaning I have 3 kids. I can give 17,000 to each of my 3 kids, and there's no requirement to file a gift tax return. We think that's going up to about 18,000 in 2024. This is indexed for inflation. And if if a taxpayer does make a taxable gift, which is anything that I've not described here, a Form 709 must be filed. That's the gift tax return. And for 2023, if your lifetime gifts do not exceed 12.92 million, excluding, gifts to spouses and gifts of 17,000 or less, it is 40% on amounts over 12,920,000. We don't see that a whole lot in practice. People just really aren't doing that, given that the numbers are so high. So let's look at an example of Abel and Baker. They have 3 children, Charlie, Delta, and Echo. At Thanksgiving, Abel gives 17,000 to Charlie, 17,000 to Delta, and 17,000 to Echo for a total of 51,000. Baker does the same thing. Abel and Baker are able to give their kids $102,000 without having to file a gift tax return and without having to pay a gift tax or report it. So I would say very common in wealthy families. They are making some type of annual gift to the kids. And again, $100,000, if you have a larger estate, and you say, well, that's just not a lot of money. Well, if you do this and an interfamily loan and you do these other things we're talking about, collectively together, if you do this over time, it can be a lot of money. And we have an example of that. So Abel, Baker, and Charlie have their 3 children, Charlie, Delta, and Echo. Abel and Baker created an irrevocable trust in 2013, which is 10 years ago. They make a gift and what I did is I went back here and they gave the maximum amount you could give without incurring a gift tax. And as you can see, if you're watching this on video, then their total gifts are adding up now to 1.1 million. So they made this habit of giving, $80, $90, $100,000 a year. And then I just put it in the S&P 500. And now you've got 1.1 million set aside. So 978,000 is given, but it's 1.1 million. And that's kind of through the end of the quarter of end of September. So actually we're in October. I said we were in September, we're in October. So this is very, very important because this is a strategy that works over time. And the concept I'm trying to share with you is if you do this as a habit over a period of time, then Abel and Baker have gotten $1 million out of their estate, which is a significant sum of money. Now, let's say Abel and Baker say, well, what if we bought some life insurance with that? So what a lot of people do is they will use a trust and they will put money into this trust and buy life insurance. So in this case, we did a 7 premiums of $84,000. And the death benefit is about $1 million. So in this particular case, they were to take, they put money in, and if one of them passed away, if they both passed away, then they would get a death benefit that goes to the children. But here they paid for 7 years and they've got $1 million death benefit. So you put in, a lot less than $1 million, and that $1 million, by the way, passes free of income taxes. So this is very, very important. Life insurance passes free of income tax. Life insurance pays out when the death tax bill becomes due. Life insurance pays out when people die. Death taxes are due 9 months after death. These are aligned in terms of when that liquidity happens, and then that gives you sufficient liquidity to then effectively pay the taxes. And there's a little bit of a detail I'm omitting, but basically that money is available to pay tax. So let's say they do both. They invest in life insurance and S&P 500. If they just did straight investments, it's 1.1 million. If they did the life insurance surrender value plus the investment, it's 1.2, and a death benefit plus the investment is 1.4. So either way, however you slice it, it's really, Abel and Baker in this case, it really did make sense for them, because they're not missing that money, to put that in a trust, because now it's outside of their estate. And after 10 years, you've got a significant pile of cash there, significant transfer from the parents to the children. Let's talk about discounted valuation. This is very important, and we're going to get to this when we start talking about trusts. When mom makes a gift of 1/3 of an interest in Greenacre to Sonny, so mom's got Greenacre, it's a piece of land, and she gives it to Sonny, the third can be discounted because what's taxed is not the value, it's not the property. It's not what mom has, it's what passes to Sonny. And if somebody gives you a third interest in a piece of property, you probably can't sell it because no one buys a third of property, right? And you can't control it because you only have 1/3 vote. So there are discounts available for lack of marketability and lack of control. These typically can be as high as 35%. Now, these are combined with LLCs and partnerships, or family limited partnerships is kind of the old schooler way of doing it, and intentionally defective grantor trusts, which we'll talk about. These discounts can be as high as 35%. So what am I talking about? What I'm talking about is many people out there can gift almost $20 million in assets, 19.8 million. And if you have a 35% discount, you are taxed at 12.92 million. So let me say this another way. When Sonny gets the gift that the government agrees is valued at $12.92 million, it's actually $19.8 million in value if everything were sold, right? So it's a way of getting assets to the next generation for less than essentially the full value, hence the term discount. So this is discounted valuation, and this works for certain asset classes. Real estate is one of them. Potentially a family business does not work as well. You're not getting nearly this kind of a discount for marketable securities. So great potential strategy, something to pay attention to. Irrevocable grantor trust. Now, this is not make work. I think some people think, oh, lawyers just make things complicated. It's been, there was an Italian philosopher who said, I would have written a shorter letter, but I didn't have enough time. This type of planning is measure 19 times and cut once. It is highly individually tailored to each person that we have as clients, because really no two situations are alike. And as you go through this, you'll see what I'm talking about. So what is an irrevocable grantor trust? Well, a revocable trust means you can amend it. You can revoke it. An irrevocable trust means you cannot amend it and you cannot revoke it. Doesn't mean you can't modify the terms, separate term, separate issue. But if it's irrevocable, it cannot be amended, it cannot be revoked. The creator of the trust on an irrevocable trust no longer owns the assets. The trust owns the assets. The trustee is in charge of the trust. The trustee has control of the assets. The beneficiary who gets what's in the trust has essentially the ownership for our purposes here. But ownership doesn't really matter because, when the president's occupying the White House, that's the people's house, right? The president does not own that house, gets to use it. And so it's a similar thing is, if that president's voted out of office, someone else is coming in there, that individual person doesn't control it. In the same way, if you're a beneficiary of a trust and not trustee, you're along for the ride. The trustee's in charge, the trustee's in control. The creator of the trust, for the trust we're talking about here, this grantor trust, irrevocable grantor trust, the creator of the trust, the grantor, is deemed the taxpayer of the assets and property that go into that trust for income tax purposes because of certain provisions in the trust. Now, this is really, really important. And I think this is one of the things that people really struggle to understand is how can I give something away and still be deemed the taxpayer, meaning I'm stuck with the tax bill, right? I put something into an intentionally defective grantor trust. I don't own it anymore. And let's say we sell it or there's income. I have to pay the tax. Like that stinks. So, but it doesn't. You'll see why that's not necessarily a bad thing. The creator must pay the taxes on any income, but the assets aren't part of the owner's estate, which is really kind of weird. You can have a provision that the trustee has discretion to reimburse the grantor. So, if the grantor doesn't have any money or doesn't have enough money, the trustee can have discretion, but you can't say that the grantor shall be reimbursed because then it defeats the whole point of the plan. So these irrevocable trusts that contain one or more Internal Revenue Code Section 675 powers are very important to understand, meaning that the person who created the trust is deemed the taxpayer. Little technical, but this is also for lawyers. So we get a lot of lawyers watching these and our staff. But the 675 power is very important. Power to deal with assets for less than adequate consideration. If the person who created the trust has the power to buy, exchange, or dispose of trust assets for less than adequate consideration in money or money's worth, that means that the grantor is deemed the taxpayer. Also, the power to borrow money without adequate interest or security. If a grantor says, "Hey, I'm going to put $1 million into this trust, but I want the ability to borrow it without having to pledge security," that means that the grantor is deemed the taxpayer. It's kind of a penalty, but we're flipping this on its head and making it a benefit. The general powers of trust administration held in a non-fiduciary capacity. This is kind of the power to vote stock or control investments, and the power to reacquire trust assets or substitute property of equal value. Very important, because when you, if this is called a swap power. Now, this may preclude the grantor from serving as trustee, but if I put property in there and I'm like, wow, the property I have isn't going up as much as the property in there, and I know that property in that I have, it might be going up a lot more, and the property that I've given away kind of isn't going up as much or has this future, I can swap those out so that the appreciation goes to the next generation. So very, very important concept to understand. That's called a swap power. There are different acronyms we use. These are variants of the same thing. An intentionally defective grantor trust, you might hear that or see that. All that means is that it is taxable to the grantor. I really don't like the term defective because clients go, why am I getting something defective? That's weird. A GRAT is a grantor retained annuity trust, another type of grantor trust. A dynasty trust, which we'll cover separately. A spousal lifetime or limited access trust, spousal lifetime access trust, or spousal limited access trust. We'll cover that separately. But this is very important to understand. When the grantor dies, the trust becomes a non-grantor trust. Now, why does this matter? Well, it matters a whole lot. And for that reason, typically it's one grantor, one trust. Meaning if it's a married couple, oftentimes those spouses will each have their own trust. You might have one trust for the 3 kids, and then the other spouse has another trust for the same 3 kids. You really don't want to do a single trust for both, because then the trust becomes half non-grantor and half grantor. And there's a lot of, again, this gets legal technical, but I just want to give you a heads up that if you pursue this type of planning and you're married, it's very likely that each spouse will end up with their own trust. And you may think you're getting over, it's a lot of make work on the lawyer's part, but that's actually the right thing to do. Situs. Situs is very important. Situs means where. Where does the trust live? Irrevocable trusts are created under state law. You could create an irrevocable trust under California law. You could create it under Nevada law. Why would you pick one state or another? Often the states with the most favorable asset protection, favorable inheritance provisions, and no state income taxes, that's really key, are states that many people cite or locate these trusts in. And sort of the top states are Nevada, Wyoming, South Dakota, Alaska, Delaware, and New Hampshire. We frequently choose Nevada as the state for to do an intentionally defective irrevocable grantor trust. And we use Wyoming for when we do a Wyoming close LLC for a lot of different kind of nuanced reasons. But many times we're using a Nevada trust, which means you should have a Nevada trustee. So that does increase the fees associated with it. But why does it make sense to go out of state? Well, first of all, no state income tax, right? So this is if the trust stops being a grantor trust when the grantor dies. You're not going to be subject to state income tax, and also the creditor protection. If you give something away to somebody, you don't want an ex-spouse to come in and take that. And so that's that creditor protection. Also the term of the trust, and we'll talk about that in a couple of slides. I did mention this irrevocable trust tax burn. What am I talking about this? If you just give an asset away, right, just to a person, you don't have these attributes. So if you use an irrevocable grantor trust wrapper, what's the benefit? Well, you put that same asset into a trust, and then there's a tax bill due. Well, instead of the beneficiary paying the tax bill, you pay the tax bill as the grantor. So you're the person who set this trust up, gave the asset away, put it in this trust. You pay the tax bill. Why is that important? Because as you get closer to death, you want your estate to get smaller, because anything that's in your estate, if you have a taxable estate, 45% death tax. It makes sense if you're going to pay the same tax, like just the baseline case. If you're going to pay the same tax, or the next generation is going to pay the same tax, it makes sense for the older generation to pay the tax, because if the younger generation pays that tax, they don't have that money. And then the money that otherwise would have gone in tax, you got to pay 45% when a person passes away. So it just makes sense to have this trust tax burn. So this is the grantor paying the trust. This applies to trust created October 4th, 2004 and later. Again, this under the Obama and Biden administration, they want to get rid of this. So you really need to move on this before it goes away, because who knows what happens in elections, right? Tax burn example. Grant creates an irrevocable trust for Sonny, gifts $1 million of XYZ stock with a $100,000 cost basis. And Grant retains the power to add a charitable beneficiary. That's another power you can add to make it a grantor trust. So when the XYZ stock is sold, Sonny gets the $1 million where it's in the trust, and Grant's stuck with the tax bill of $300,000. This is effectively an extra $300,000 gift to Sonny. All right. This is burnt. The taxes are burning Grant's estate. And this is a great strategy for people who believe they will live a long time. This is a bet to live strategy, as Robert Keebler so artfully put it. This is a bet to live strategy. If this were a bet to die strategy, we might have done a self-canceling installment note that goes away when Grant dies. So if Grant said, hey, I'm only going to live a couple years, we do the self-canceling installment note. But if Grant says, hey, I'm going to make it to 110, then we would be looking more at the gift strategy and burning the tax burn. You can also do a sale and a gift. And I know I'm getting a little down in the weeds, but it's important for you. If I'm going through this too fast, just if you're watching this recorded, just go back and take a look at it again. Let's say Grant creates an irrevocable trust for Sonny and retains the power to add a charitable beneficiary, gives $100,000 in XYZ stock, and sells $900,000 in stock. Now, because Grant is the taxpayer, there's no realization of capital gain. And he takes a note for 4.11%. The XYZ stock returns an average of 14.11%. So the math is easy. This is $1 million in profits to Sonny over a year. Well, Sonny keeps that. Grant's trust has paid Grant $702,000 in interest, tax-free to Grant. So the interest is tax-free coming back. And in year 20, the $900,000 principal is returned. So basically, Grant is renting this stock to Sonny, and Sonny now has $4.6 million. And this is after paying the interest and returning the $900 principal, right? So this is effectively a wealth transfer. So if this, you could have private company stock if you own a business. A lot of people do this if they own a business, if they know, gee, we're getting about a 14% return based on this interest in the business. Let's go ahead and lend that, right? And then have that come back. But all that extra 10% on that million year over year goes to Sonny, and Sonny now keeps a lot of money. Let's say Dad's healthy but doesn't think he's going to live very long. He gives $12.9 million in company stock for the benefit of his daughter. We covered this, and sells the remaining $10 million of company stock for a note. The note carries a mortality risk, as we mentioned. There's no capital gains tax. In that prior example, there was capital gain, right? But in this situation, there's no capital gains tax because he is selling it. It's like if you sell something to yourself. So what Dad's doing is Dad is, as an individual, has this stock or in the company stock, and he is selling it to a trust that is taxable to Dad. So there's no realization of capital gains tax. Dad pays tax on all the income, but not the skin payments, because that interest is, he's paying tax on the income in that trust, but the self-canceling installment note payments are not taxable. And the trust makes two payments of $545,000. Dad dies, no death tax, right? So this is an example. Instead of just giving it all and paying a gift tax, you do the self-canceling installment note, right? Because Dad is going to live shorter. So again, if this is a little confusing, go back and take a look at it. As I mentioned, I think these are in the crosshairs with certain administrations. Both the Obama and the Biden administration want to end grantor trusts. And I'm not making a political statement. This is a statement of fact. So you can be a Democrat and love Biden and Obama and understand, if you're wealthy, this planning strategy is going away. So that's just something to be mindful of. It may go away. It's on the chopping block. It never quite gets to the chopping block or gets its head cut off, but it is on their radar screen. Private annuity, again, this is another sort of a bet to die strategy, I guess you will. Allows you to move an asset out of your estate in exchange for annuity payments. So Granny, age 95, transfers $10 million to Sonny in exchange for annuity payments. And when Granny dies, the payments end. So this is also based on your actuarial life expectancy. So those might be big payments, but understand, this is why I'm saying that sometimes death taxes can be optional. So private annuity can be a very useful strategy. Dynasty trust. So what are we talking about here? We're not talking about the TV show. Think of a dynasty trust as a long-term locked treasure box. Okay, this is a box that's passed from generation to generation. You can't, if you pick the right jurisdiction, creditors aren't going to be able to attack it. No divorcing descendants, spouses, future descendants, ex-spouses can get access to that money. And what a lot of people do is they will work with a lawyer, create a dynasty trust, and will move assets into that trust during lifetime, right? So what we're talking about here is the dynasty trust that's created during lifetime. and you can put 12.92 million in there. And this is no gift tax. Couples can transfer 25.84 million. Now they might be using separate dynasty trusts, but they can transfer a total of 25.84. This money, if you pick the right state, like Nevada has a 365-year term, this trust can go on for 365 years. That money under current law will never be taxed when someone dies, again, just because they pass away. Now, you might have income tax, but it's not going to be subject to a death tax. Now, again, there are in Biden's proposed budget from last year proposed to end this so that this only lasts as long as all the people named in the trust are living. And then once the last person dies, it could be 100 years. Once that last person dies, it is taxable. Many of these strategies, by the way, do end up getting grandfathered in. I don't know if this one would get grandfathered in or not, but if this is you, if you're like, yeah, we'd like to put 13 million or 26 million into a trust and never have it taxed again. Yeah, let's do it. You're probably not going to do it in California because California's maximum term is 90 years. You're going to be picking another state. You might have to have a trustee and a professional trustee in that state as well. So there's a little bit of care and feeding. But how do these work? The dynasty trust always owns the assets, right? Not the individuals in any generation. They are beneficiaries, so they can get distributions. There's no tax on the distribution. I mean, there might be setting aside income tax, but there's no tax based on that distribution, the money going from the trust to the individual beneficiary. And depending on how the trust is written, the person making the gift can be the trustee and maintain 100% control, but sometimes not. It depends on how these are written. So if you create this trust, sometimes those people stay on as trustee, but sometimes they don't, but then they have other powers. And I really don't want to get in the weeds on that, but just know that sometimes you're trustee and sometimes you're not. Once these assets go into this locked treasure box, they're not part of your estate, no death taxes. And there is also, not only can you put 12.92 million, you can give somebody 12.92 million, you can put 12.92 million in a trust that skips generations, that opts out of the generation skipping transfer tax. So what this is if you say, hey, I'm wealthy, I'm going to skip my son and leave it to my grandson, that the government taxes you again on that. So if you try to leave money to someone 37 and a half years younger or 2 generations, it's a duplicate, it's another tax. So how this works is if I have a 10 million taxable $10 million transfer, 40% taken out in taxes, so that leaves 6 million, and then another 40% on the 6 million is taken out, so another 2.4 million. So it's a very taxing endeavor. You really want to avoid the generation skipping transfer tax. It's something to be mindful of. But with a proper dynasty trust, estate taxes only need to be paid once when the trust is funded, if at all. After it's funded, that money can be used for future generations. And this is the example we covered. Grandma gives 22.92 million to grandson, 10 million is taxable, and the tax bill is 40% on the 10 million, and then another 40% on the 6 million. So a lot of taxes, very, very taxing. Situs, again, many dynasty trusts are not cited in California. If you're a California resident, states typically, again, it's a state that has no income tax, favorable creditor protection, and long life expectancies. States that have long trust life expectancies, meaning you want to have it, more than 100 years. California is not one of these. Alaska, South Dakota, Wyoming, and Nevada. These other states have eliminated something called the rule against perpetuities. The rule against perpetuities says trusts cannot go on forever. Well, South Dakota's eliminated that. Right? There's no federal, by the way, there's no federal property law. And a lot of people don't know this. Property, what is property, is defined state by state by state. Okay. And that has our own unique legacy in the United States. And what property is not a federal question. It's always a state question. And South Dakota has said you can have a trust that goes on for 1,000 years. Nevada says 365. So it's better than California, which is 90. Spousal Lifetime Access Trust. What are we talking about here? This is a really powerful tool. So in 2023, Able creates a spousal lifetime access trust under Nevada law and puts 12.92 million in it. Beneficiaries are Baker, Abel's spouse, and their 3 children, Charlie, Delta, and Echo, in a common trust while Abel and Baker are alive. So what happens? This is a trust where one spouse gives money to another spouse, but in a trust, so it's outside of both spouses' estates when the spouses die. Okay. So when Abel and Baker are dead. So Abel says, you know what? I'm going to give a bunch of money away, and I'm going to have my spouse, Baker, and my kids, Charlie, Delta, and Echo. all beneficiaries of what we call a common trust or a pot trust, P-O-T, common trust, pot trust. When Abel and Baker die, when the parents die, property is divided into 3 separate trusts for Charlie, Delta, and Echo, and they split the sheets. They go their separate ways. 3 dynasty trusts. Okay, it spins off. The property passes free of estate tax and death taxes, and this is even though the value, this could grow to $50 million. Passes free of estate tax, and they save millions and millions of dollars. Abel doesn't get anything out of this. And so when they go out to dinner, who's paying, Abel or Baker? Baker's going to pay, right? If they need some money to live on, maybe Baker makes that withdrawal. And then Baker can, I mean, you would not put this in the trust, but Baker can do anything Baker wants with the money, even help out Abel. Now in 2025, Baker creates a Wyoming dynasty trust. So remember, Abel in 2023 created a Nevada spousal lifetime access trust. Baker creates a Wyoming dynasty trust and puts 12.92 million plus inflation in it. The beneficiary, so this is Baker, the other spouse. The beneficiaries are Abel and Baker's 3 children for the life of Baker. Well, and this one we might do Baker's 3 children for the life of Abel. I think that's how that should be written. And it's significantly different than Abel's trust. We're trying to avoid the reciprocal trust doctrine, and we'll talk about that in another slide. When Baker dies, Abel becomes a beneficiary with Charlie, Delta, and Echo in a common trust. Yes, so this is the beneficiaries are Baker's 3 children, not Abel. So Baker sets up a trust. Abel's not a beneficiary. Baker's 3 children, Echo, Charlie, Delta, and Echo are the beneficiaries. When Baker dies, Abel becomes a beneficiary with Charlie, Delta, and Echo. Kind of steps in to be a beneficiary. And then when Abel and Baker die, the property is divided into 3 trusts for Charlie, Delta, and Echo. The property passes free of estate and death taxes, even though it grows to 50 million. If you are in a community property state, you will need a postnuptial agreement, which means the couples typically come to one. If a couple comes to our firm, we're going to say each of you, Abel and Baker, needs to go get your own lawyer and do a postnuptial agreement. Otherwise, this won't work. And a lot of people go, well, this is ridiculous. This seems stupid. It's not stupid. It's a requirement. So each spouse has to retain separate legal counsel. And again, the attorney handling the estate plan for the individual, for the couple, will not handle it for the spouses. So this is a big deal. The reciprocal trust doctrine is a judicially created principle that is designed to deter estate planning where 2 trusts are created equal. So if Abel and Baker on the same day with the same lawyer, each did spousal lifetime access trusts that are the same terms, the IRS is going to say, no way. If it's separated in time, you go to separate counsel. That is how, and the trusts are different. That's how you can not get stung by the reciprocal trust doctrine. So this is real. And there are cases before the tax courts where this has been applied. So you got to be really careful with this and really know what you're doing. So we have covered 5 ways to avoid death taxes: intrafamily loans, annual gifting, irrevocable, grantor trust, dynasty trust, and spousal lifetime access trust. And very important that you use a 3-legged stool. With this, remember the A team, right? The attorney, the CPA, the financial advisor. These 3 professionals need to work together. If you have assets of over 10 million, we have a multifamily office. So this is where you basically hire our firm on an ongoing basis, and we're paying attention to all this stuff. So if you go, oh, I set this up, I don't understand anything, we can help you. Or if you have this set up and maybe your lawyer's retired and you don't have a lawyer, give us a call and we can help you with that. We also have my book, Savvy Estate Planning, What You Need to Know Before You Hire the Right Lawyer. We do cover a lot of the, not so much the tax issues, but the basic estate planning issues. We have offices throughout Northern and Southern California, and we are also meeting a lot of clients on Zoom like everyone else. Next week, we have planning considerations for business owners, and this will be with Christina Lindsay Orta. Very, very important. If you're a business owner, estate planning is even more important. So I think you understand why. And the link is in the chat. And if you're watching this on YouTube, please subscribe to our YouTube channel and click the bell. You will be reminded when these come up, when the videos are released. We will open it for questions. If you are watching this on YouTube, just keep watching because another video is going to roll right after this one.